The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of either Raymond James or Serving Those Who Serve.
Hello and welcome, everyone, to this episode of the FedLife podcast. I am your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve and Lee Sipe & Associates. And I want to begin, as I always do, by saying thank you. Thank you for taking the time to listen. And thank you for your service to the country, to the government, to me, to everyone. You do not hear that enough. You will always hear it here. And the other thing you will always hear on the FedLife podcast is the guru, Ed Zurndorfer. He is back with us once again as part of that ongoing mission to reach, teach, and serve you, the career civilian Fed. At the outset, I need to say the opinions of our guest, Ed Zurndorfer, are not the opinions of Raymond James or Serving Those Who Serve, and that this podcast is presented for information only and is not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. If you don't have a personal advisor, hit us up at stwserve.com. We will help you any way we can. Once again, we're following Ed's FedZone articles to give us one more way to reach and teach. So if you're an audio or a video learner, this is a great place for you. The articles are in the FedZone at fed-zone.com. They're dynamite. You should read them. So Ed, we're talking open season again, and you have some key ideas for Feds to consider. Your first article talks about enrollment types and tax savings with the FEHB program. So you begin with the three types. Why don't you take us through those?
Okay, the FEHB program, the Federal Employee Health Benefits Program. There's also the Federal Employee Dental Insurance Program. They offer some tax savings for federal employees, both federal and state tax savings. I'd like to review a few of those, the ones I mentioned in the column. And the first tax savings or tax benefit, I should say, that employees as well as retirees enjoy is the fact that the federal government contributes on average 72 to 75% of the premium costs, no matter which plan an employee or retiree is enrolled in, no matter what type of coverage, self-only, self+1, self and family. The federal government pays on average 72 to 75% of the premiums for that particular health insurance plan.
Sure.
That contribution by the federal government is not taxable. It's a tax freebie. It's a tax freebie. When your employer pays part of your health insurance premiums, no matter which employer. It could be the federal government. It could be a private employer. Any contributions that the employer makes towards the premium cost is not considered to be taxable income. It doesn't show up on the employee's W-2 as a taxable item. Certain benefits that the employer pays on behalf of the employee are taxable, but health insurance premiums is not one of them. The second tax benefit that employees, but not retirees, enjoy is the fact that the premiums that they pay, in the case of the federal employee health insurance, the other 25 to 28% of the premiums that they pay for a particular health insurance plan that they're enrolled in is deducted from their gross salary before all taxes. Let's do an example to help illustrate. Let's say an employee, his gross salary for the year is $100,000. Make it nice and easy. And in their particular health insurance plan that they're enrolled in, let's say the annual premiums that they pay total $3,000 a year. So the $3,000, Dan, is deducted from the $100,000. So now the employee's taxable salary has been reduced down to $97,000 because the $3,000, as I said, is deducted from the gross salary before all taxes. That includes federal income taxes, before federal income taxes are withheld, state income taxes, Social Security taxes also, and Medicare Part A. If you look on a W-2, a standard W-2 form, there are three boxes that employees should note. One is box one, taxable wages. So my example here, the taxable wages are $97,000. Box three, Dan, is something called Social Security wages. Social Security wages. So in this case here, the Social Security wages are also reduced to $97,000 because it was taken out, the premiums were deducted before any Social Security, the FICA tax was applied. And finally, box five, Medicare wages are also reduced down to $97,000 because the premiums are deducted before any Medicare hospital insurance tax, which is, I think, 1.45% of the employee's wages. So that is a benefit for employees only. Retirees do never have their premiums deducted, the 25 to 28% of premiums they're paying from their pre-tax annuity. It's always deducted after after annuity is been subject to federal and state income taxes. And this is not an OPM rule. This is an IRS rule.
Gotcha.
The Internal Revenue Code does not allow retirees to have their premiums deducted from their pensions on a pre-tax basis. It's always deducted on an after-tax basis. So that is item number two. And the third item is that if employees only, again, participate in the healthcare flexible spending accounts, we're going to be talking, I know we'll be talking more about that later, but federal employees have the opportunity to contribute money to a healthcare flexible spending account in which the money coming out of the healthcare FSA can be used to pay for out-of-pocket medical, dental, and vision expenses. When I say expenses, I'm talking about things that the insurance doesn't pay, or deductibles, co-insurance, co-payments. The money that goes into that healthcare FSA, and for 2024, it's been raised to $3,150, I believe, is deducted from the employee's gross salary, once again, before all taxes, federal, state, Social Security, Medicare Part A. So
Gotcha.
Here's the benefit. The fact that money going into the healthcare FSA is coming from pre-tax dollars. And when the money comes out of the healthcare FSA, it's not taxable. So there's a real benefit here. So those are the three items.
Gotcha. And also in your article, you talk about there's sort of three different ways that people can be enrolled, as themselves only, as family, that type of thing. Why don't you talk about those as well?
Yes. In the Federal Employee Health Insurance Program allows employees as well as retirees three types of an enrollment, three types. The first enrollment type is called self-only. That's easy. It's only the employee or the retiree. The second type of enrollment is called self and family. Self meaning the employee or retiree. Family includes a spouse, children under the age of 26. So, and no matter how many children are enrolled, self and family encompasses that enrollment. I just want to point out that that's not true in general. In you work in private industry, if you are enrolled in a company-sponsored health insurance plan and you have self and family coverage, you normally have to pay more in premiums for each additional individual who's enrolled in the plan. So you could, if you have, let's say, one spouse and one child, that's self and family, okay, that's one rate. Then you add a child, you're going to pay more in premiums. Another child. So that's not the case with the Federal Employee Health Insurance Program. So that's self and family. And then we have self plus one. Self plus one enrollment means the employee or retiree plus one eligible family member, usually a spouse. But it doesn't always have to be a spouse. Say you have an employee who's a single parent. They have themselves, self, and they have one child. That also could include self plus one. So those are the three types of enrollment. I'd just like to share with you, Dan, a question I've been getting from both employees and retirees. This is coming from retirees. Ed, I'm enrolled in the XYZ Federal Employee Health Insurance Health Plan. and it's just myself and my wife or my husband, just two of us. And something very strange is happening. I note that the premiums that we're going to be paying for self plus one coverage are more than the premiums for self and family. How could that be? It doesn't make sense to me, Ed. You're talking about two people, not multiple individuals here. Like have self and family coverage, the employee, spouse, and 4 children. How could that be? And my response is that the federal employee health insurance plans, they do a lot of studies. They have a lot of actuarial studies to determine those premiums. And some of the federal employee health insurance plans that cover a lot of retirees, annuitants. These are annuitants. These are retired federal employees, and they are generally in their 60s and 70s, some are in their 80s. They noticed that what they're paying out in benefits for these retirees for self plus one coverage is costing the insurance company more compared to self and family coverage that covers young families or mid-career families. And they say, I still don't understand what you're talking about it. Well, let's think about it. The type of expenses that senior citizens incur include hip replacements, heart bypass surgery.
Sure.
The cost of those type of procedures is more than, I would have to say, than having a baby.
Yep.
Yeah. So the insurance company said, look, we have to make money. So we're going to figure out actuarially what is the best way to charge premiums. And therefore, because self plus one, some of these plans, it's costing the insurance company more compared to self and family. They're charging more in self plus one premiums. Now, that's not all plans, but I have a statistic that I came across. There are 44 FEHB plans, 44 FEHB plans in which self plus one premium rates are higher than for the same plan compared to self and family. So I encourage if individuals are listening during the opening season here, because the opening season ends on December 11th, they should check that. Okay, about if they're looking to enroll in self plus one, they should also compare it to the self and family.
None, and that makes perfect sense. As a matter of fact, the cynic in me wonders if insurance carriers said, hey, let's see if we can find a way to get older people to self-identify. Oh, I know, self plus one. And one other thing, Ed, because I know we've touched on it in our webinars and podcasts before, if we've got 2 feds that are retiring, there are some cases where 2 self-onlys might be less expensive for them, correct?
That is correct. But I just want to point out something, Dan, about that. It's been my analysis. When you're talking about 2 feds, two federal employees, the 2 federal employees, and they're married, and they retire, and they have a choice. They could either have 2 self-only coverages or 1 self plus one. Self plus one. Okay. It's been my study the analysis that in most cases, 2 self-only coverages is cheaper in premiums compared to 1 self plus one. But there are exceptions. There are some exceptions. And I caution those retirees when they ask me a question, should we go to self-only? I said, a couple of things you got to consider here. Number one, the plan that if you're going to go self plus one, if you're going to choose self plus one, for whatever reason, self plus one, that both spouses will like that plan. Their doctors are in that plan. They're in that plan because all plans do not cover, not all doctors, may accept that insurance. So each spouse has a different doctor. They got to make sure that the doctors do accept that plan in terms of being like a preferred provider. That's what self plus one. And the other, compared to self-only, I caution individuals, number one, that when you have self-only coverage, you each have to reach your own deductible. You have separate catastrophic limits Okay. So you have to be careful about that to make sure that price wise, if you each are going to be enrolled in your own coverages, that you're going to have to make that separate deductible. You have separate co-insurances, things like that, and separate
Sure.
catastrophic limit each that you're subject to. And one other comparison I tell in retirees and employees in which both spouses are enrolled in federal health insurance. Let's say one spouse is going to retire in federal service, and the other spouse is going to continue in federal service, maybe retire down the line. Well, in that case, Self+1 enrollment might be advantageous for two reasons. If the FEHB insurance is in the name of the employee, they're the self, okay? And the spouse retires is the one. That's the one who's going to retire.
Gotcha.
Okay? Then the premiums that are going to come out of the employee's paycheck is pre-tax dollars. That's premium conversion.
Gotcha.
That's premium conversion. It's going to be cheaper compared to having the premiums coming out of the annuitant's check, in which the premiums are going to be deducted post-tax. It's going to be a little cheaper.
Gotcha.
That's the first possible savings. The other consideration is that if the employee who retires, I should say, is going to be enrolling in Medicare because they're getting close to 65. Well, if they have self-only coverage, have the insurance in their name or the Self+1 coverage is in their name, then that individual, that employee retires, will have to enroll in both Medicare Part A and Medicare Part B. Medicare Part A is free. That's not going to be an issue. But Medicare Part B, you have to pay a monthly premium. So here you're paying the Self+1 coverage premiums, and the annuitant's paying that on a post-tax basis. Okay. And they're going to have to enroll in Medicare Part B. Whereas if the coverage of Self+1 was the employee's name, when we said the premiums are being deducted pre-tax from the salary,
Sure.
and the spouse who retires, when they reach age 65, they would not have to enroll in Medicare Part B because they're covered by their spouse's FEHB insurance, and they would not be required to sign up for Medicare Part B because they're still under a plan in which the spouse is still working. When would the spouse who is retired have to sign up for Part B? Once the employee spouse retires, and then they have it's called a special enrollment period, the SCP. They have an 8-month period to sign up without penalty, because that could save some dollars too.
Gotcha. And actually, that's a great segue, Ed, because your final section, your article, talks about premium conversion. And remember, folks, that's your ability to make your FEHB premiums pre-tax. But you indicate some reasons why somebody might not want to do that, which I'm pretty sure our feds don't normally consider. And what are those points?
Okay, there are 3 reasons why an employee may want to consider not participating in premium conversion. If an employee doesn't make any election, they're automatically subject to the premium conversion. But they can opt out of premium conversion during the open season. And here are 3 possible reasons an employee may want to opt out of premium conversion. The first reason is called flexibility. What do I mean by flexibility? Those employees who do not enroll in premium conversion would be allowed to get out of the federal employee health insurance in the middle of the year for whatever reason they want to get out. I didn't say suspend their FEHB insurance. I'm talking about they want to get out of the program. Normally, you can only do that during an open season.
Gotcha.
Okay, that would be one reason. Another reason regarding not participating in the premium conversion is You can change your enrollment. What do I mean by changing enrollment? This is not a life event. Somebody decides, I have self and family coverage. I want to switch to self plus one. Normally, you can only do that if there is a life event. Okay. But if you don't have, you're not a participating premium conversion, you can do that anytime during the year. Okay.
Gotcha.
Keep in mind again that we said that with most plans, self plus one coverage is cheaper than self and family. The premiums are cheaper compared to premiums for self and family. So then the employee decides, well, I want to go to self plus one then. Unless there's a life event, they couldn't do that if they're participating in premium conversion. All right, that's the first reason.
Sure.
And the second reason is not a major reason. It involves the effect of participating in premium conversion. How will that affect your future Social Security benefits? Okay. Remember what we said earlier, that when you participate in premium conversion, the premiums that you pay for federal employee health insurance are deducted from your gross salary before all taxes, federal and state income taxes, and Social Security and Medicare Part A payroll taxes.
Gotcha.
By not having those premiums subject to that you're paying, subject to FICA tax, it will reduce your future Social Security benefits. Because what are Social Security benefits, retirement benefits based on? Your highest 35 years of Social Security earnings. Whatever you earned in your 35 years of working, or more. Social Security, when they compute your Social Security retirement benefits, they're looking at the 35 highest years of Social Security earnings. Box 3 on your W-2. By the fact that the Social Security, that the premiums are being deducted before Social Security taxes, it's going to reduce your Social Security earnings. How much effect will it have? Dan, it's not going to be much. I did a study a couple of years ago showing with the savings that you're getting by participating in premium conversion, if you take that amount of savings and put into a passbook savings account, now we know interest rates are low, or a money market account, you could invest it over the years, you could overcome the reduction in your Social Security retirement benefit. But some people feel differently. No, I want to get the maximum Social Security, so I want to make sure. Okay, so you have a choice.
Gotcha.
Okay. And the third reason, and this is probably the most important one. When an individual participates in premium conversion, an employee participates in premium conversion, the premiums that they're paying are, as like say, are coming before all taxes. They're getting a tax break. They're getting a federal and state income tax break.
Sure.
When they file their income taxes every year, and if they itemize, they file Schedule A. One of the itemized deductions is medical and dental expenses.
Sure.
So in order to deduct medical and dental expenses, the out-of-pocket costs that you have for medical, dental, vision expenses, that includes deductibles, co-insurance, co-payments, things the insurance doesn't pay for, have to exceed 7.5% of one's adjusted gross income. And I hope on God's good earth, no one ever has to deduct medical expenses. You don't want to do that. For example, here you have, let's say, an adjusted gross income of $100,000. In order to deduct any expenses of medical, dental, vision expenses, you have to pay out of pocket more than $7,500. That's a lot of money. Either you don't have good insurance, or you and your family are incurring big expenses. It is possible that a federal employee in a particular year may incur a lot of medical, dental, and vision expenses. Okay. they're going to have a lot of, surgeries, things like that, particularly dental, orthodontics, things like that. They pay a lot of pocket. Dental insurance doesn't pay for everything. There's usually a limit what they're going to pay for. The fact of the matter is that if an employee expects in the coming year, they're going to have a lot of out-of-pocket expenses. Well, if they participate in premium conversion, because they're getting the tax break via their premiums are being deducted before all taxes, they can't turn around and take the premiums that they're actually paying and include them as an itemized deduction. They can if they don't participate in premium conversion. So
Gotcha.
that may be a reason to opt out in every year. And this is a year-by-year decision. You don't have to be in premium conversion every year. You can opt out during the open season, saying, well, for next year, I don't want to participate in premium conversion because I expect to have a lot of income, and I'm going to deduct those. I'm going to include those premiums I pay for federal employee health insurance as an itemized deduction. But keep in mind, Dan, 7.5% is a lot.
Agree.
Number two, now most people do not itemize. They take the standard deduction. Under the Tax Cuts and Jobs Act of 2017, because the standard deduction has been doubled, most people now do not itemize. They just take that standard deduction. If you take the standard deduction, this conversation, what I just mentioned about itemize, it's useless because you have to itemize.
Gotcha.
The Tax Cuts and Jobs Act of 2017, unless Congress renews it, will go out as of January 1st, 2026. And if we go back to what it was in terms of the standard deduction, not being doubled, maybe more people will be itemizing. Then it'll be a different decision regarding whether you should participate in premium conversion or not. Just one
gotcha. No, that makes sense. And to round out what you covered in the article, you also indicated that if folks are looking to make changes, if they're employees, they'd have one path, retirees the other. With retirees, it's retireefehb.opm.gov. But then with the employees, you indicated they can submit the SF 2809, but also they may have online and self-service options as well.
Yes. And employees are encouraged to contact their HR personal office, and how to go about making these changes in terms of their FEHB coverage.
Gotcha.
When it comes to the dental and vision insurance, the FedLife, they need to go to www.benefits.com, www.benefits.com. Talking about dental insurance, I want to add that when it comes to premium conversion, those employees who participate, who are enrolled in either a dental insurance plan or a vision insurance plan or both through the Federal Employees Dental Vision Insurance Program, they must have their premiums deducted pre-tax via premium conversion. They have no choice. And retirees never can participate in premium conversion, whether they have the federal employee health insurance or the federal dental vision insurance or vision insurance. Premiums are always deducted post-tax.
Gotcha. Ed, once again, you're digging into stuff that most places aren't covering. So that is awesome. You're helping people understand things they might have missed. So as I always do, I'm going to thank you for being such a great resource to the feds and to us as well. Folks, that's a wrap for today. We are Serving Those Who Serve. Be sure to subscribe to this podcast on our YouTube channel and Spotify. Remember to share it with your friends and strangers. Check us out on Twitter and LinkedIn. Don't forget the live webinars every single week. You can find those at swserve.com. Click that button and you will get the whole menu. Sign up for one, sign up for all. The guru will come to you. Be sure to read Ed every month in the Fed Zone at fed-zone.com. There's always great stuff there. So wrapping it up, for Ed, the crew, and Serving Those Who Serve, and me, Dan Sipe, I will close as I always do by saying good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one, because you deserve it. Stay well, everybody. We are out.